Hello, everyone, and welcome to another episode of Monday Macro Review. From the previous few episodes, we were focusing on different regions like China, like Eurozone, like United States of America. But today, I thought it would be good to give you an overview and provide an outlook of the whole overall global economy. So we're going to find out whether Eurozone is doing better or not, whether Chinese economic indicators have improved, what's happening in the US, what are the estimates regarding the United States interest rates moving forward, and how does the market sentiment tracker takes the recent news. So diving in, first of all, important news from the Eurozone. Dutch economy has entered a recession, contracting minus 0.3%. This is the second consecutive quarter that the Dutch economy has contracted in. And to remind, this is Eurozone's fifth largest economy. This is important to note because it speaks about the overall health of the region's economic outlook. And I believe, and Mark has talked about it in his Econ show as well, that challenges, especially for Eurozone, continues to pile up. Consumer spending in the country fell about 1.6%, while exports were down 0.7 to 0.8% in the first 3 months of the year. It is also important to remind that between 2021 and 2022, the Dutch economy almost expanded by 5%. So as compared to 5% in 2022, and now minus 0.3% contraction in 2023, that is a steep plunge, a fall that might take a little bit of time to recover. Secondly, if we talk about the whole Eurozone region, they have registered a modest growth of 0.3% in the second quarter of this year, according to Eurostat. However, on annual basis, the economy of Eurozone grew only by 0.6%. This is the worst economic performance of Eurozone since the recession of 2020 and 2021. Within that, if you look at the employment figures, it has increased about 1.5%, and the largest economies like Germany and Italy, they have stagnated further. And we have spoken about German economy in the last episode as well, where we saw construction activity falling down, new car exports falling down, manufacturing activity falling down, and the likelihoods of Germany falling into another recession quite high. Moving on to China, because China remains a formidable force in the global economy, and it's important to see what's happening there. And recently, the economic data coming out of China has been everything but promising. You can see on this chart that Chinese diesel inventories have built up since January, since the start of the year, and the overall demand outlook also remains quite low. So Rystad Energy lowered its forecast for Chinese diesel demand for July to December to 3.8 million barrels per day from 3.9 million barrels per day. This is because of so many reasons, like idling equipment because of a fall in construction activity, falling exports. Diesel demand is quite linked to these economic sectors. And if you look at IEA's prediction about Chinese diesel demand, it's not that the diesel demand has been slow today or these days. Whether we see it in 2024, the slowdown seems to spill over into the new year as well. So amid a slew of disappointing Chinese economic data, analysts have further lowered their outlooks for the diesel usage. IEA has cut its 2023 forecast by 127,000 barrels. Rystad has done so by 94,000 barrels per day, and the weakness is expected to persist at least till the mid of next year. That speaks a lot about whether the global economy would see some sort of recovery or a V-shaped recovery when we move into the next year. I still believe that a recession in the US is impending, and we're going to talk about it as well. But these indicators, such as usage of diesel, copper stocks, Chinese imports of oil, these all are quite symptomatic of a persistent slowdown. If you look at the real estate construction sector, which is a very important contributor to the overall Chinese GDP, the activity here has remained well below 2019 levels, as you can see in this chart. The real estate construction fell about 71.7% from the monthly average in 2019. Chinese exports, of course, we've talked about it recently, plunged almost 15% in July, and this was the fastest pace since the onset of pandemic. That is once again a very serious downturn, given that many were expecting that Chinese economy would roar back from its recent recession. If you look at the Chinese oil inventories, recently the refiners in China, which has been refining at record high paces, about 63 million metric tons in July, about 14.8 million barrels per day, they have also tapped into the to their inventories, which the country, of course, has been building up recently. So refiners used about 500,000 barrels per day from stockpiles in July for the first time in 33 months. That says a lot about two things. First, that China has, as prices continue to rise, we might see that the Chinese import figures of oil may drop because, of course, prices are quite high this time of the year as compared to previous year. And secondly, that also talks about the domestic demand, which is in one way or the other quite not there as analysts have been expecting. If you move on to the largest economy in the world, which is the United States of America, you see that the long-term yields are on the rise, and people are. So there were lots of Wall Street investors and businessmen. There was an article in Reuters as well. They confessed almost that they got it wrong. That yes, interest rates, given that many indicators in the U.S. economy are still resilient, they expect interest rates to remain higher for longer. And that, of course, only increases the probability of a recession. And you remember that we spoken about this in the previous shows, that many estimates sort of project this time around New Year's or in the winters. And as these indicators seems to be moving, you can see this spike after August in this chart on the right-hand side. I think that might become true. So the tail, but however, many people have been avoiding or not pricing in the tail risk of a recession. For many people, that might not be a tail risk at this point, but for many it is. And I still believe, as you will see here in this market sentiment tracker chart, that market fundamentals are being overshadowed by sentiments. You see the left side, the recessionary side is still high. It's still thronged with negative news, bearish news regarding the global economy. Chinese construction is down. Germany's industrial economy is down. Exports are down. Eurozone fall in services. However, there are also some positive news emerging on the other hand. But when you take into account these positive news, you need to look at the base case. If the base case is really low, which it is, like for instance, you're comparing things with when there was a COVID lockdown or when the global economy was at its bottom, then things might look more promising than they actually are. So that's all from my side today. See you all next week. Thank you so much for watching.